With what we've seen over the last 10 years, I know you've done some analysis on the data point in terms of the return that small caps have offered us over the last 10 years in comparison to the top 40. Can you take us through those numbers, Sean?
Well, I think if one looks at it very roughly, small caps have outperformed your mid and your large cap over the past 10 years. Small caps giving you roughly about 22% annualized, compared to your large caps around about 13.5%. And what's interesting as well is that has come at a lower risk. The small cap outperformance has come at a lower risk as measured by standard deviation than what maybe the large caps have. And it's potentially because of a domestic story. I mean, small caps are very heavily weighted to the domestic economy, and obviously large caps have a large resources exposure, and that could also have created a bit of volatility in the top 40 sector.
Deryck, isn't that a big argument to have exposure to the small stocks if you want to outperform? And just going back to those numbers, 22% annualized for small caps, 20% for mid caps over the last 10 years this is, and then only 13% for the top 40.
It comes down to a question of risk and return, as we mentioned earlier. But I think, those numbers could be a little bit distorted. I think what one also needs to keep in mind is just before we went into the financial crisis, we had a listing boom where we had so many of these small caps come into the market, look to raise capital, raised it at the completely wrong time, and a lot of them hit the wall. And actually, a lot of investors were severely hurt during the period of 2007 until where we stand now. So yes, they have given you an annualized return of 22%. But I think one needs to place great importance on selectivity within the small cap arena. You've really got to look for your cash flush businesses. You've got to look for fundamental value. You can't just go in and sort of throw a dart and say, well, let's just get a basket of small caps. There's a lot of homework that has to be done within the small cap arena.
And Sean, that is the homework that you do, effectively looking at the companies that do have solid balance sheets and good, strong management. Can you give us a little bit more color around that strategy?
Of course. I mean, we are looking for those sort of well-run companies where your management acts with shareholders' interests at heart. And I think, if you look over the longer term, Deryck's quite right that you had the IPO boom. But a lot of the outperformance has come from companies that have been around for a lot longer and have come at a lower risk than what the top 40, if one wants to use a standard deviation as a risk measure. So in order to generate alpha on a portfolio, I mean, we would always argue that you need exposure to the mid-small cap arena. We just maybe say that your weighting should maybe differ. But if you look at a company like a Cashbuild or even a Wilson Bailey, and our Wilson Bailey is probably 24% off its high. But if you bought that company in 2000, you would have paid roughly about 100 shares would have cost you about 340 Rand. Those 100 shares are now worth almost 10,000 Rand, plus you've got about 1,000 Rand of dividends to boot. So there definitely is an argument for buying the good quality counters, solid balance sheets, and buying them with a long-term focus.
If you were to look at the current small cap arena, which stocks would best suit that mold? Or fit that mold, rather, would be the terminology to use.
Well, I think it's across the board. Deryck also mentioned being selective, and I think he's quite right there. Across the board, there are pockets of value with individual companies. And ironically, the companies that look the most expensive at a specific point of time are the ones that still have a lot of growth coming through for the future. And we saw that with Spur. If you looked at Spur in 2000, you probably wouldn't have bought it because it looked relatively expensive on most measurements. But that share has also returned a phenomenal return over and above the market over that 10-year period. So selectively, the construction sector does look cheap at the moment. There are the arguments for the construction sector. We are aware of the 2010 now, that peg in the ground having come and gone, and earnings visibility going forward is at risk. We also know that there's about 850 billion rands worth of infrastructure spend. We just don't know when that will come. So the construction sector, those companies are pricing in a large amount of the downside, but very little of the potential upside. And the sort of work that we're sort of looking at is that the current share prices within the construction sector are probably discounting about a 50% drop in operating margins. Now, we don't know if that's going to happen, but what we do know that if it does happen, we're paying the right price for the stocks now. And if that drop in operating margin is less than that, then the market will look at them favorably.
Which are your favorite construction stocks? I'm not letting you off the hook that easily. So WBHOs is still one to accumulate at these levels, given that outstanding performance over the last 10 years?
We still like it from a financial structure point of view. It's not the cheapest of them around there, but I think one must look, and see what companies will benefit from the potential infrastructure spend, and that's surrounding Eskom. And then also on the road, I think the next sort of rollout of expenditure is going to be on roads, and your Basil Reeds kind of benefit from that one. But also bear in mind, there's a lot of competition for tenders. Previously a tender of R1 billion would have been ignored by the larger construction companies. Now they're all tendering for it. So you want to at least get to those companies that can tender favorably. Obviously the operating margins will be under pressure, but we think that's discounted in the share price. And also remembering the smaller construction companies, they win R100 million tender, it's far larger in their books than a Murray & Roberts, for example. So I think being a little bit cautious, obviously I think investing in this area, the construction stocks, you might need a little bit of patience and probably a little bit of capital as well, because you want to, if that infrastructure spend is later rather than sooner, you want to be with those companies with a solid balance sheets. And that's the basis of them. Basil Reed, Group 5, Wilson Bailey, all acted quite soundly in the past period to restructure their financial statements.
Sean, thanks very much for your time. Sean Stockett, Small Caps Fund Manager, joining us from our Cape Town studio, and Sean's from Stanlib. We've got to focus on Alcoa and the fact that that is going to be the first stock component that reports after the bell this evening. Having done some research, I see out of the S&P 500, they're expecting earnings growth to be around about 27% across the board. And for the last 3 quarters, we have seen 22% earnings growth. What are analysts expecting for Alcoa? Pretty much in line with general expectation?
I think they're exactly what you said, in line with the expectations. But I think within this earnings season and possibly the next one is going to be very key to where we see the global environment go on equities as a whole. And I'm waiting in great anticipation to see what happens with Alcoa tonight. Generally what happens is, when Alcoa do release their quarterly results, it kind of sets the tone and the undertone for what the market will do for the next 2 months. So whether it beats analysts' expectations, you might find that Eastern markets rally on the back of that tonight. And whether
Isn't it almost a given that markets will rally? If we see Alcoa beating expectations, specifically on the growth, on the top line, then we'll see markets coming in for a big rally.
Of course, you're going to see some big buying coming into the market. You're going to see fundamental buying, smart money buying coming into the market. And why these 2 earnings seasons that I'm specifically highlighting at the moment is, given the fact that we've got this low base effect out the way at the moment, to get these companies to give you some good solid returns, you are going to need quality earnings to drive these companies. So if we do see better than expected expectations out of Alcoa tonight, then I'm hands up and say, you know what, we're starting to see some quality earnings come into the market, come into the equity arena, and that's enough conviction for me to start committing some more money to the market and starting to more than overweight in equities.
We've got a number of big banks also reporting this week. We've got Bank of America, Citigroup, JP Morgan, and then Google, not in the banking environment, but also good barometers of what is happening in the US. Where do you think we're going to see those banking earnings going?
Look, I think what we must remember is that the correction that we went through was driven by the banks. So although their balance sheets were completely, obviously they needed to be bailed out, and there was all sorts of austerity measures that had to step in to come and get them back online, they have started to repay quite a lot of their debt. And personally, I think it's going to be a bit of a mixed bag. I don't see any significant outperformance by the banks or any sort of underperformance by them. You might have one bank that sort of gives you a bit of a surprise, slightly to the upside, but pretty much in line with the expectations. I don't see anything in those banking stocks really giving me convincing buying opportunity just yet. But like I said, the market looks forward in nature, and I think by the next set of earnings that starts to come through in 3 months' time, I'll buy into the market on the back of better than expected earnings as we move into the next quarterly results.
Deryck,